Imagine you're standing in front of your closet, agonizing over which shirt to keep and which to toss. You spend hours meticulously researching every new piece you want to add to your wardrobe, but when it comes to getting rid of stuff, you just grab whatever looks the most worn out and toss it in the donation bin without a second thought. Sounds familiar? Well, it turns out that even the most sophisticated investors might be falling into a similar trap when it comes to managing their portfolios. Hello everyone, this is Professor Ikram, and today I'd like to share the results of a very interesting study with you that investigates the buying and selling decisions of professional money managers. This paper recognizes that the factors that influence people's buying decisions may be quite different from those that influence their selling decisions. Think about it. When you're buying a stock, you're likely focused on its potential for growth, the strength of the company's fundamentals, or maybe how it fits into your overall investment strategy. But when it comes to selling, a whole new set of considerations can come into play. Maybe the stock has hit your target price, or perhaps you need to free up cash for another opportunity. Emotions like attachment or loss aversion can also cloud your judgment in ways that don't necessarily apply to buying. For their study, the researchers analyzed a rather large data set on the daily holdings and trades of 783 institutional portfolios, worth an average $573 million each. And what they found is that while professional managers consistently displayed a knack for picking winners when buying stocks, their selling decisions told a completely different story. On average, the stocks they chose to sell underperformed by a significant margin, 80 basis points per year to be precise. Perhaps more surprisingly, these professional stock pickers' sell decisions often did worse than a purely random selling strategy. In other words, they would have been better off letting a blindfolded monkey pick which stocks to sell. Now, the researchers didn't stop there. They wanted to understand the psychology behind this puzzling phenomenon. Why this disconnect between selling and buying prowess? Upon digging deeper, the researchers proposed two possible behavioral explanations. First, they suggest that managers are allocating their mental energy unevenly, focusing intently on finding the next big buy while neglecting to give their sell decisions the same level of scrutiny. As a result, they may be more prone to fixating on attention-grabbing stocks, those with extreme good or extreme bad recent performance when it comes time to sell. Second, when deciding which of these extreme stocks to unload, managers seem to be swayed by their emotional attachments. They're more likely to sell off the positions they have the least conviction in, the proverbial ugly ducklings of their portfolios, if you will. Now, as you can imagine, this kind of emotional or heuristic-driven selling can lead to expensive errors. Indeed, the researchers found that the more a manager relied on these mental shortcuts, the worse their overall portfolio performance tended to be. Alright, so what can investors like you and me learn from all this? Well, first, this is a powerful reminder that even the most experienced and well-resourced traders aren't immune to the pitfalls of human psychology. We all have biases and blind spots that can lead us astray if we're not careful. More concretely, though, it emphasizes the importance of being just as rigorous and methodical in your selling decisions as you are in your buying ones. Just like with your closet, it's easy to get caught up in the excitement of acquiring new assets while neglecting to prune your portfolio regularly and thoughtfully. So in my opinion, the key takeaway is that before you sell, ask yourself, am I basing this decision on objective analysis and a well-defined strategy? Or am I simply reacting to recent performance or my own emotional attachments? Taking the time to slow down and thinking critically about your sells can help you avoid costly knee-jerk moves. Remember, careful selling is just as important as savvy buying. If you'd like to dig deeper into the research methodology and findings, I highly recommend checking out the full paper for yourself. Link is in the description below. And if you have your own experiences or tips to share about mastering the art of selling, I'd love to hear from you in the comment section. All the best in your financial journey. This is Professor Ikram. Thanks for tuning in. If you found this video useful, click the like button and subscribe to the channel. And feel free to ask any questions using the comment section. Happy learning.